The VIX Filter Income System. A stress-free, rules-based approach to generating consistent daily income from options without the chaos from day trading. Common mistake: the day trading trap. What you don't need: 6 monitors cluttering your desk, hours glued to charts every single day, constant stress and decision fatigue, complicated indicators and guesswork. What you do need: a clear, repeatable, rules-based system, simple criteria that tell you when to act, discipline to follow the plan, and patience to wait for the right setup. Trading doesn't have to be complicated. The best systems are built on clarity and consistency, not complexity. Understanding volatility. The insurance analogy. We only sell insurance when premiums are expensive, just like selling flood insurance during a storm warning. The VIX, your fear gauge. The volatility index, which is the VIX, measures market fear. Higher VIX equals higher option premiums equals better income opportunity. Green light, red light. VIX removes emotion from the equation. It's a simple, objective signal that tells you when conditions are favorable. The red light rule. If VIX is below 20, do not trade many naked options. When volatility is low, option premiums shrink to unattractive levels. The juice is rarely worth the squeeze. Now, you are going to have to sell some options when VIX is trading below 20, primarily because the market spends about 70% of its time with VIX below 20. However, when VIX is trading below 20, you want to reduce your size and not sell too many options. Why wait? Low premiums mean poor risk-reward ratios. You're taking on risk without adequate compensation for that risk. Discipline is key. The hardest part? Sitting on your hands. But patience protects your capital and keeps you ready for high-quality setups. The green light rule. If VIX is trading over 20, execute and increase your size. Market fear is elevated, which means option premiums are rich and attractive. Juicy premiums. High volatility inflates option prices. This is when sellers have the edge and can collect meaningful income. Time to sell more puts. With elevated premiums and heightened fear, it's the ideal environment to sell cash-secured puts on quality assets. You can also use margin, whether it be Regulation T or portfolio margin. The trade setup. Assets. SPX or XSP, which is the S&P 500 index. Why SPX or XSP? Better tax treatment under Section 1256. 60% long-term, 40% short-term capital gains, regardless of the hold time. This is if you're in the United States. Expiration 1 DTE. 1 day to expiration means you're capturing maximum time decay overnight. Fast premium erosion equals daily income. Goal: consistent small wins. We're not swinging for home runs. We're stacking small, repeatable profits that compound over time. The strike price selection. Go 5 to 10% out of the money. Selling puts well below the current market price gives you a massive safety cushion. The market has to drop significantly before you're at risk. In late March 2026, when VIX was trading over 30 and the S&P was trading at about 6,300, I sold put options on SPX that had a strike price of 4,800. So I actually sold put options that were about 20% out of the money, and I picked up $4,500 of premium. Then, the day after I sold and opened this position, the market increased substantially, with the S&P going up around $150, and I made a 50% profit in about 1 day. High probability of profit. The further out of the money, the higher your win rate. You're stacking the odds heavily in your favor from the start. Sleep well at night. With a wide buffer, you're not sweating every market tick. This setup is designed for peace of mind, not anxiety. Key strategy: the velocity rule for profit taking. Hit 50% profit fast. If your trade reaches 50% of max profit within the first few hours of the trading day, then close the trade. Don't wait around hoping for more. Take your profits immediately and bank the win. I need to do a better job at this myself. In that example that I gave you where I sold the SPX option with a strike of 4,800, the very next day when the market spiked up, that trade showed me a 50% profit, and it expires in the middle of April 2026. So the days to expiration was about 14, but I still have that trade on even though it's showing me about a 65% profit. Take the cash and run. Greed kills traders. Lock in your gains, free up capital, and move on to the next opportunity. Velocity matters more than perfection. Fast profits compound faster, and they also reduce your risk exposure. Why velocity matters. Markets turn quickly. Momentum can reverse in minutes. Locking in profits early protects you from sudden market swings and unexpected news. Higher win rate. Taking profits at 50% boosts your overall win rate. More winning trades equals more confidence and consistency in your system. Capital freedom. Closing trades early frees up buying power. You're ready to jump on the next high-quality setup without being tied up in old positions. Risk management, the golden rule. 10% maximum buying power to 1 DTE. Never deploy more than 10% of your buying power on 1 DTE daily income strategies. 50% safety reserve. Overall, always keep at least 50% in reserve. This buffer protects you from margin calls and gives you room to maneuver if things go wrong. Capital preservation comes first. You can't compound gains if you blow up your account. Always leave room for potential losses. If you have any questions, leave a comment below. Please like this video and subscribe to the channel. And if you visit BestStockStrategy.com, you can enter in your email address and receive over $400 of valuable free training.